This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 13th. Some highlights from today's show. Tariffs narrative is fading fast. German DAX now holds some important clues, and US CPI data is in focus. A good day, traders, and welcome to the Daily Market Rundown. Let's get stuck straight into it. Looking across the board to the overnight session, not a great deal's going on, and that's for very good reason. We have, of course, got the key risk event for the week, which is the US CPI in just around 45 minutes time from now. So we'll get on to that in a minute. We'll talk about that in a minute and what to watch out for. Some of the overnight moves, I think it's a continuation theme, particularly for the likes of oil and the commodities. Again, with this idea, of course, with China and the US now calming things down, we can see, of course, demand coming back for those commodities, and why not? Okay, a sort of a de-escalation between the two biggest economies in the world just means we're going to consume a lot more, and of course we will see some of the rebound in the likes of the commodity space. With that in mind, let's get across and talk a little bit about what's going on the tariff situation. And there's a very good article this morning out of the Bloomberg, actually. And it's kind of looking at what we got out of the weekend and trying to sort of summarize it in terms of who won. Okay, because I think it's very, very important to look a little bit deeper as to what was achieved and who gave what, in a sense, because we'll start to understand what the playbook is going forward. Okay, now coming into, of course, this tariff weekend, both sides believed that they had the stronger hand, they had the leverage. But at the end of the day, to understand who really had the leverage, we just have to look at what was agreed. And that's what this article is going on about. They're talking about this ideal of, China ultimately got every one of their core demands reached. Okay, and what did they have to give up as a result? And that's the whole key to this, is that not only did they get it below, not only did they get rid of the retaliatory tariffs that were put on the board on Liberation Day, but they didn't have to give up anything to the US. And that's the key, is that effectively China won the battle. Now we have to ask ourselves why. Well, we know it wasn't necessarily the stock market, because we, of course, did see the stock market rebound significantly. And so we got to ask ourselves, well, what was it then? What created almost a sort of a 180 pivot from the US administration? And I suspect it comes down to ultimately what yields are doing. Okay, there was perhaps some concern that if we didn't see a pivot very quickly, not only would we see the US economy come to a standstill in terms of trade with China, but we would then also, of course, start to see much, much higher prices, which would eventually lead to higher yields. And of course, we all know the implications of that. So the point of this article, a fantastic read, definitely worth reading through, is that effectively China won here. Effectively, China had more leverage simply because they were perhaps willing to accept more pain in terms of the long run. So great article, definitely worth reading. But the key I want to take away from this is not so much who won the battle. That's not about, China won, woohoo. It's more about what happens now with the likes of EU and Japan. Because I can tell you right now, the negotiators will be sitting there thinking, well, wow, if China can get that much out of the US, what can we get? Okay, don't forget, the EU is a massive trading partner with the US. Japan, obviously less so, but Japan is still a very, very significant trading partner with the US. So effectively, if China had leverage over the US, the likes of the EU and Japan are going to be very closely studying ultimately how they managed to get that much leverage over the US. And I do suspect you're going to see not just Japan and EU, but also China get very, very favorable trade deals once the dust settles over the longer run. Now, let's talk a little bit about what that means ultimately for our scale. Well, again, yesterday I came out and said, well, at the end of the day, this 10.4% seems to be now the lower bound. But if we go back to this model and we think to ourselves, well, China won over the US and Japan and the EU are going to follow a very similar playbook, well, I do suspect then that we could actually start to see this move even further to the left. Now, this is not necessarily the base case currently that you'll be reading about, but I suspect this is what perhaps some of the big institutions, some of the big hedge funds will be thinking about, which is if China can get a deal that is that strong relative to what we had, of course, after Liberation Day, the likes of the EU and Japan are all going to secure much, much lower deals than expected. Now, don't forget, Trump did tell us originally that no one will get less than 10%. Then he came out and he softened. He said, well, in some specific cases, cases, we may be willing to go below the 10%, but I suspect what we're going to find in the long run is that quite a few countries are actually going to get less than that 10% across the board tariff. Okay, so what that means is the effective marginal tariff rate, I suspect, is going to start to move somewhere between 2.5% and 10.4%, and not the other way. Now, of course, we could still see headline flow over the next couple of days, weeks and months, where we see the retaliation again, we see sort of backwards and forwards, but reality suggests that now, if anything, the high probability plays to see those tariffs even squash below that 10.4%. Okay. Now, again, we could see another little step down from the US, and this just confirms again this pivot, this 180 pivot from the US administration. Yesterday or the day before, they came out and said they will not effectively cut the de minimis tariff. Now they have decided they will cut it. Okay, why? Well, because any package effectively over $800 was having to pay a very hefty 120% fee on top of that $800, which effectively meant that most small packages coming from China were just no longer feasible. That's now been cut to 54%. Okay, again, just suggests that there is some concern perhaps that, you know, we're going to lose a lot of business in the US, a lot of items off the shelves, perhaps much higher inflation that we don't really want to be importing at this time. Okay, just another step down from the US administration. Now, whether you like the US administration or not, that's not the point here. The point is that it is sometimes very good to see these pivots, and ultimately for us as traders, we've just got to be aware of these pivots because, and we'll get to this in a minute, when we talk about the S&P 500 and what comes next, don't be surprised if we are at record territory in 3 months' time or 4 months' time. And we'll talk a little bit about that in a moment. It's not that I'm flipping my book. It's not that suddenly, you know, someone who was calling for a dead cat pounds 2 weeks ago is now bullish, mega bullish. That's not the case. We'll talk about that when we get to the chart. But it's important to stress that you have to be nimble as a trader. You've got to learn to read between the lines, because in the same way that we are accessing this information in real time, we've got to be updating our thesis in real time. Okay, one of the key lessons I learned, and this was horrible, if you traded through COVID, and you go back and look at sort of May, April, or May, June, July, I remember timeless conversations with other traders where I was like, you know, you sell this thing and it never goes down. And the reality, what we came to learn, is that the narrative switches pretty quickly, and big institutional players switch their narrative pretty quickly. Okay, so if you're stuck in this sort of mindset of, oh, well, you know, tariffs and are going to end the world, blah, 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 the reality is you're going to miss what's right in front of you, which is a roaring bull market. Okay, so we'll talk a little bit about that in a moment, but let's talk a little bit about the DAX, because it does hold a very, very important clue. Okay, what we can see in the DAX is a 26% rally over the last 22 days, and again, just absolutely no pullback. Okay, we have one time framed for a sequence now of 16 days, which I haven't ever seen a 16 daily time frame sequence. But what I want to point out is we, of course, yesterday opened up into record high territory. That is the previous high, record highs. And the key takeaway was, look at that daily close yesterday. Okay, now it's not that this necessarily means you want to start selling the market, but yesterday's close off of very, very positive news is something we always want to be aware of. Okay, and the key takeaway from it is that perhaps this market is a little bit full. It's got a little bit of indigestion. We talk about indigestion, where it's just gone up a little bit too far, too fast. That there is no natural impulsive buyer now. Okay, there's no real initiative right now, simply because, well, the big players bought it there, then they bought it there, then the CTAs joined in. Now, who's going to buy it now? Okay, that's why I'm pointing this out, is because there's no natural buyer currently, but that could, of course, change in the coming days, weeks, and months. Okay. The key takeaway is keep a close eye on the DAX. We get back below that 23,500. I suspect we'll probably come a little bit lower, maybe even to that 23,000 level, maybe. Okay, the point is that I do expect a little bit of consolidation for the next couple of sessions. Once that breaks out, don't forget, DAX leads to the upside. Okay, DAX is the star outperformer. Once that breaks to the upside, I suspect that's going to be a very telling clue, of course, for the US equity market as well. Okay, keep an eye on that market. Definitely want to watch in terms of the clue. Now, Bitcoin was exactly the same yesterday, which is why I've got it up. On a day where we had the sort of the very, very positive news, Bitcoin actually finished the day down. And of course, we also did have an outside day. Now, does that mean obviously Bitcoin's going to collapse in the near term? No, absolutely not. But the key takeaway is it's almost like the market was bidding up into this sort of China agreement. And now we're going to need some new fundamentals ultimately to get the market moving higher again. Okay, and that brings us to the S&P 500, because it's no different. Okay, the S&P 500 is now back at the the 200-day moving average. You can see it there. Note it is a flat, slightly leaning to the downside 200-day moving average, so it's not as significant as something like this. Okay, the slope of the 200-day moving average does matter, and the more slope it is, the more relevant it is in terms of support and resistance. Okay, that's the basic rule of thumb. In this sense, okay, the moving average is quite flat, so it's not really, I wouldn't treat this as any significant resistance. But like I said the other day, the 5900 is somewhere where the market has respected for some period of time. And ultimately, the same thing yesterday. You could see we opened. We, of course, rallied into that 200 moving average. And right now, the market's just sitting, waiting. Okay, now, like I said to you, a lot of buys down there, a lot of buys there, some CTAs there. We can see the VIX now back at sort of 17.5. That's also going to initiate more CTA buying. The point is right now we are at a massive little area. Okay, it's an area where, you know, gun to the head, if you ask me what comes next, I would tell you it depends. And I think everything depends on what happens to the CPI today. Why? Well, like I said 2-3 weeks ago, the tariff narrative started to soften already 2-3 weeks ago. Okay, already when we got to sort of somewhere over here, the tariff situation or the narrative was fading away. In other words, it was less important for the market, and what was becoming important for the market was the hard data. Okay. And today we get probably the most important hard data point that we've had all year. Why? Well, because now the market wants to know what comes next. Now the market wants to know, well, you know, we've got these tariffs in place. We've got all this uncertainty. What are the implications for inflation? Because if inflation is going to come out hot, it means that we need to effectively get rid of all the rate cuts, you know, for this year. If the number comes in weak, perhaps we need to put that rate cut on for the July Fed meeting. Okay, and that's the kind of the key sort of position we're in today. Sorry, the June meeting. That's the key position now the market's in, which is we don't actually know at a hard data level what is the implications of the tariffs. Okay. And so, depending on what happens today, if that number comes out hot, I can tell you right now, we're probably going to go and fill down that 5,700 gap, and then we'll probably have to wait for the next data point. And until the economic situation improves dramatically, we're going to struggle around that 5,900 level. Okay, and that's why today's number is so important. If the number comes out soft today, if inflation comes out soft, think of the construct of the market right now. Not only do we have a solid economy, like Jerome Powell said 1,000 times at the meeting last week, we have a solid economy, we have the administration that's now done a 180, and things are going to be a lot better than anyone expected. We have a situation where, like I said, even the likes of Japan and EU are going to get lower than their retaliatory tariffs. And so the scenario starts to become very, very positive. Throw into that the fact that everyone on Wall Street, with Trump's policy of tariffs, was expecting a double-digit return this year. Okay, don't forget, we're still about 1% down on the S&P. If money managers and fund managers still think 10%, you know, is likely in terms of the thesis right now, okay, we've got a hell of a lot of upside over the coming days and weeks should we suddenly get a weak CPI print today. Okay. And so there's a number of things that point towards ultimately higher upside should that number come in weak. But one of the key ones, okay, I mentioned to you the DAX having indigestion. One of the key ones with the S&P that I suspect you'll start to read about over the coming days is this idea of, you know, the pain trade. What is the most painful thing the S&P could do right now? Well, the reality is no one institutional-wise bought it down there. Okay, fine. We probably had some hedge funds taking risk-reward bets, a couple of Trump insiders. I get that. The reality is that very few money managers put money to work down there. Okay, we had a VIX sitting at 60. No one is going to put money to work. Even in this 10% up day with a 90-day extension, money managers were not going to put aggressive money to work. And I suspect very few money managers have put money to work because they want to wait for this 90-day extension, etc., and get some clarity. So if we start to bid up now because of CTA activity, and we start to get up and up and up, money managers are going to start to shit themselves, and they're going to have to deploy cash, and they're going to be deploying it perhaps at record high territory. Okay, and so the pain trade right now is definitely to the upside, but like I said, you're going to need that soft CPI print. You're going to need the hard data to start accelerating again. You get that, the pain trade's very much to the upside, and that's when I think the thesis does shift. Okay, so do I still think this could be a dead cat bounce, locking in some very, very bullish positions? Absolutely. But you are going to need the bad data to justify that dead cat bounce. Okay, the way I like to think about this, we could be talking about this 5,900 level in a couple of weeks' time, and I could be saying to you, oh, it was so obvious, 5,900. And yes, 5,900 is obvious. But for this to hold as, the pullback level, you are going to need the hard data to justify it. Okay, and only then will we eventually get that move lower. But like I said, if the hard data starts to improve, the CPI suddenly misses today, don't be surprised to see the pain trade up over the next couple of weeks. With that in mind, there is the VIX. I'm not going to talk too much about it. You can see, of course, we're all the way back down at 18.5s in the VIX. Where does this bounce? Well, again, this very much depends on CPI. We get a hot print today, a 0.6, a 0.7 on the month-over-month. Well, guess what? That VIX is going to be back at 22 pretty quick because very few people are hedged right now. And of course, we have had a significant rally to the upside, so there will be quite a few people wanting to hedge those upside positions. So keep an eye on that. I think the VIX is going to be very much dependent on ultimately the CPI. We come in soft on the CPI. What does that mean for VIX? Well, I think we're probably going to go full that gap down to 16s, and that's only going to add more support to the market. You're going to see that CTA activity ramping up, and you're going to just start to see this grind up every single trading session. So keep an eye on that VIX. And then finally, of course, it is the CPI print. Expected today for both the headline and the core month-over-month is 0.3, but there's a very, very wide range of expectations. Looking at the headline, it's expected, the range of expectations is from minus 0.1 up to 0.6, and I've just highlighted that 0.6 so you can see that the last time we had a 0.6 print was back in 2022. Don't forget, the Fed began the process of hiking rates in the first half of 2022. So what does that mean for the Fed? Well, if they see a 0.6 today, they're not exactly going to be happy. You are going to see the bond markets push out that first rate cut, perhaps even out of September into December/next year. That will scare the equity markets a little bit, just simply because of how much they've done over the last couple of sessions. And then, of course, we do know that the dollar has been relatively firm over the last couple of sessions. So that should do well should we get that big print in terms of the CPI. And like I said, in terms of the miss, if we did get a miss, I mean, that opens up the door to a number of different things. It kind of, opens the door to a Trump effectively lambasting Powell being late to the party. And I do suspect if we did get a weaker print, even a negative print, I do suspect you will see the Fed sort of perk up a little bit, perhaps even open the door to moving at the next meeting. So anything goes today. That's the key. This is kind of a flip a coin situation. You get a very weak print, you get a very strong print. The market is going to literally respond either way. Okay, it's very much a binary outcome today. And I think the key market to pay attention to, of course, is the front bonds. Just keep an eye on the front bonds. They will tell you ultimately if this is going to prove to be, bullish or bearish for the equity space. Okay, with that in mind, if there are any other questions, we've got half an hour until the data point. So do add those questions there, and hopefully we'll have enough time to answer them. Otherwise, if there's one thing just to pay attention to today is the number is 0.3. If we do have some big outliers, don't be surprised to see some crazy moves because we are coming off of a situation where the implied volatility for the last sort of week or so is quite muted. Okay, so big prints either way should wake things up a little bit, and there'll be some great opportunities as a result. That's it for today. Good luck out there. Manage the risk. Go make some money.